Hello investors and future investors, welcome back to the channel. In today's video, I'm going to show you how I maintain a 90% success rate when trading Iron Condors. My name is Tim, welcome to Investment Gains. Now, the Iron Condor is one of the most profitable strategies out there, and quite honestly, it's one of my favorites. Now, the Iron Condor is also a four-leg option strategy, which makes it a bit more complicated for new investors, new traders. Now, in order for you to perform the Iron Condor, it comprises of two separate option strategies, namely the put credit spread and also the call credit spread. I'm going to give you a step-by-step walkthrough with examples of how this is done and how I maintain my 90% success rate. Now, I do this on a daily basis. However, you could feel free to perform it on a weekly basis. If you are trading with an account below $25,000 and you don't want to get caught up in the PEDT rule, then stick to the end. I'm going to show you a strategy I use to avoid that, what I used to trade with a smaller account. So, for today's video, we're going to be using the Investo QQQ as our stock to trade. So let's go ahead. We're going to go to Trade QQQ Options. Now, before we jump into this, just remember, I would really appreciate it if you guys would to like and subscribe to the videos below. Now, if you guys have any questions concerning this Iron Condor strategy or any other strategy that we feature on the channel, feel free to leave a comment below. Now, like this video said, I'm going to show you how I maintain a 90% win rate using the Iron Condor. So we're going to go ahead to sell, and then we're going to choose our put, because we're going to start off this trade by selling a put. One of the most important criteria is make sure you choose the correct date. Now, the strike date I'm going to choose for this is going to be July 2nd. Now, the reason I'm choosing July 2nd is that I already have some contracts for July 1st. So now we're going to go ahead and we're going to choose our strike prices below the current share price. As you can see, the current share price here is $479.50. Now, if you are new to investing or trading, here's a rule of thumb. What you want to do to be on the safe side while you're learning to become a better trader, you could choose 5 to 6 strike prices below the current share price. Now, the current share price is at $479, so we're going to go 5 below. So 478, 477, 476, 475, 474. Now, I like a very good margin of safety, so what I'm going to do, I'm going to go ahead and I'm going to choose the 472 strike price, and as promised, this is going to give me a 90% chance of profitability or a 90% chance of success rate. We're going to go ahead, we're going to click that. Now, this is just one leg, and this leg is a sell put. So we are selling a put, so we'll receive a credit of 29 cents or $29. Each option contract is multiplied by 100 shares. Now we're going to go ahead and select our second leg of our puts. So now we're going to go down and we're going to choose our second strike price below the current strike price of 472, and I'm going to go with the 471, which is directly below the 472. Now make sure it says buy and put and using the exact same strike date, and then we're going to go ahead and select the 471. Now in this case, we're going to be buying a put, so we have to pay. Now the difference in our sell put that we did previously and our buy put is going to be 0.06 cents. Once again, we're going to be receiving a credit. Most of the strategies I feature on this station always involve us getting an upfront credit because that's just how I like to do it. Now that we have completed this, now we're going to go ahead and do the top part of the Iron Condor. Now, like I said previously, the Iron Condor comprises of two option strategies. The one we just did is known as the put credit spread, as you can see here. If you try to do this strategy and it does not say put credit spread, please go ahead and do it one more time. You are doing the wrong thing. Now let's go ahead. We're going to go back to the strike price. Now, for the third leg of this, we're going to make sure it says sell and call. And while maintaining the exact same strike date, we're going to proceed to look for a 90% chance of profitability once again in order for us to choose our strike price. Let's go ahead and count $5 to $6 above the current strike price just as a measure of security. So we're going to go to 480, 481, 82, 83, 84. And you should be taking the 84, which gives you an 80% chance of profitability. But like I said by the thumbnail in this video, I like to maintain a 90% chance of profitability, which gives me a 90% win rate. So I will be going with the 486 strike price. And as you can see here, it's going to give me a 90% chance of profitability. We're going to go ahead and we're going to select that one. Now, this is a sell call. So once again, we will be receiving a credit. Now we're going to go ahead and we're going to choose our last leg, which is going to be a buy call. So let's make sure it says buy and call, and once again maintaining the exact same strike date. We're going to go ahead and choose our buy call right above our sell call, and that's going to give us the 487 strike price. We're going to go ahead, we're going to select that. Once we do that, you will see that Robinhood is going to change it to the short Iron Condor. Now, most importantly, what I try to teach people on this channel is the amount of credit you receive for doing these option strategies. In this case, this short Iron Condor is going to pay us 15 cents or $15 per contract. This is not the end of the contract. We need to go ahead. We're going to hit continue. Now we're going to choose our amount of contracts. Now this is where your risk tolerance comes in. Now this is the stage where you need to choose the amount of contracts you want to buy. Once again, each contract is multiplied by 100 shares. My personal preference is to go between 10 to 20 contracts. But for this video, I'm going to be going with 10 contracts. Now, with 10 contracts, I stand to gain $178.80. Let's round it up to $180 in credit. That goes into my buying power right away, and that money is to be used by me for whatever purposes I want. I will never lose that money. Now, in order for me to go ahead and perform this contract, I will need to leave a collateral. Now, the collateral for me to leave to use this is going to total $1,000. Now, how did I come up with the $1,000? Each of these option contract is going to be $100. The $100 comes about by the spread. So let me show you what I mean by the spread. So between 486 and 487, that's a spread, and that's a $1 spread. 487 minus 86. Now that $1 spread, once again, multiplied by 100 shares will give you $100, and that's how you get the collateral. Now all I need to do here is go ahead and hit submit, and all I have to do is just wait for a fill. Now, for those of you that are trading with less than $25,000 account, this is how you avoid the PDT rule. You would want to open a contract on, let's say, just for example purposes, July 2nd, and you're going to close it out on July 3rd. On July 3rd, you're going to open another contract and you're going to close it out on July 4th. What this allows you to do is get daily revenue, and it allows you to avoid the PDT rule because you're closing the contracts on another day as opposed to the day you open it, avoiding the day trading rule. Now, it's better to use the Iron Condor in stocks that have consistent movement. My personal preference is to do an Iron Condor on either the QQQ or the SPY, and there's two reasons for this. They both have daily expiration dates, and both of them hardly ever moves. They usually move between a 1% gain or a 1% loss throughout. Before you go into any options contract, always make sure you have an exit strategy. My exit strategy is always to close out the trade when I'm up 75 or 80%. I never let any of my trades go to expiration. And once again, that's just my personal preference. Thanks for watching, and remember, keep pushing your investments.